To be with you all this evening, and I'm especially delighted to have the opportunity to share a podium with Cathy Minehan. Cathy was not only an able participant in the monetary policy making process of our country and a superb president and leader of our Federal Reserve Bank here in Boston, but a terrific contributor in many more general ways to the Boston community throughout her service as president of the Reserve Bank. Being a leader of that kind of institution is not just about what happens inside the institution, it's also about how one comports oneself and what kinds of contributions one makes to the community more broadly. And Cathy certainly carried out that role exquisitely and for a very long time, and all of us here in Boston are particularly grateful. Now, that said, I want to begin my remarks by disabusing you of something that Cathy said. Monetary policy, for all practical purposes, has nothing to do with money. Money is just not what monetary policy is about, the name notwithstanding. Think about some of the statements you do not read in the newspaper today. You do not read that the economy is shrinking because the money stock is going down. Why? Because it isn't. You do not read that the problem is that the monetary base provided by the Federal Reserve is going down, because it isn't. The monetary base is going up. You do not read that households and firms are spending less because they don't have adequate cash balances. That isn't the problem. They have plenty of cash balances. You do not read that our problem is that the central bank, the Federal Reserve, is being too restrictive in providing reserves to the banking system. To the contrary, the reserve base that the Federal Reserve has supplied to the banking system is today more than 20 times what it was a year and a half ago. None of the current problems of the economy have anything whatsoever to do with money in the sense of deposits and the usual monetary base of the banking system. What then is monetary policy actually about? It's about three aspects of the way in which our credit markets work, all of which are very centrally involved in what our problem is today. People's willingness to spend and firms' willingness to spend, and moreover their ability to spend, depends in the first instance on the volume of credit, that is borrowing, that they can get. Second, it depends on the cost, the price of that credit, in other words, the interest rate. And third, it depends on the availability of that credit, meaning the other conditions that banks and other lenders place on people's ability to get loans, in addition to and beyond the mere interest rates that are charged. Now, of course, in some simple textbook constructions of how the banking system works, money and credit are simply two sides of the same thing. But that would completely miss why the economy is in trouble today, namely that we have a credit crisis, at the same time that there's absolutely nothing wrong with the price of money or the volume of money that's there. Depository institutions have lots of ways to finance lending other than issuing deposits, and many of them do that. And so as a result, it's simply not true in practice that money and credit are two sides of the same thing. Furthermore, depository institutions are constrained in two important ways in the lending that they can do. One is in the reserves that the Federal Reserve provides. But to repeat, the reserve base that's been provided to the banking system is today more than 20 times what it was a year and a half ago. Why then are the banks not lending? Not because their reserves are inadequate, but because their capital, in other words, their net worth, the difference between what they own and what they owe, is inadequate, and nothing that monetary policy does in the first instance is going to correct that problem. As a result, lending that's being done is inadequate, and the important role of policymakers at the moment is to correct the impediments that are preventing the lenders from lending. Now, to see why this is a problem, it's important to go back to where the problem first began, and that is in the perverse interaction among three separate groups of participants in the housing market. To begin, homeowners, of course, are eager to buy houses whenever they're enabled to do so, and they're eager to buy as nice a house and as large a house as they're enabled to do. And further, those who already live in houses and have no intention of moving to a bigger one or a nicer one are typically eager to borrow against the value of the houses that they already own so that they can spend on other items. So the problem is, in the first instance, in the behavior of the homeowners who, for understandable reasons, were eager to borrow, both to buy houses and to spend on other items. The second group of participants are the lenders, who are eager to make loans. Why? Because they earn fees in that way, and further fees for putting those loans that they make into packages and selling them to investors. As a result of the desire to earn fees on extending loans and packaging them and selling them to investors, together with the gross failure of the regulatory establishment, importantly including the Federal Reserve System, lenders lowered their credit standards to levels at which anyone should have known that the loans had little likelihood of being repaid. Third, if the lenders are going to lend loans, lend money, and then turn around and sell the loans, there has to be someone who's going to buy them. This is where investors come into the picture, and for reasons that are difficult to understand today, investors proved all too willing to buy securities which were nothing other than claims to loans which everyone should have understood had little probability of being repaid. So we have three groups of participants in the housing market: the homeowners, also the borrowers, the lenders, in other words the banks, and investors, in other words bond buyers, all interacting in this perverse way. The further along this process went, two developments in the real economy took place, both of which proved unsustainable. First, as the lenders lent more money to people who could not afford to repay so that they could buy ever more and ever more expensive houses, house prices rose. Between the year 2000 and the year 2006, house prices on average in the United States rose by 60%. So any house that you bought in the year 2000 for $100,000 was, on average across the country, worth $160,000 6 years later. Second, as a result of all of this demand for houses, more houses were built. In a typical year, historically, in the United States, for the amount of family formation that we have ongoing at present, we would build approximately no less than that. We would build approximately 1.5 million houses in a year. At the peak in 2005, 2006, we were building approximately 1.5 times that amount of houses. We were building more like 2.25 million houses. Now think for a minute about a phenomenon in which the price of something is going up rapidly, at the same time that more and more of what it is that the price of is rising is being put onto the market because more and more houses are going up. The answer is that this process has to turn around. In the first instance, even without the additional supply of houses, the prices were just getting too high. The price of ownership to the price of renting was out of line. The price of buying a house compared to the median family income in the country was getting out of line. And it was clear that house prices had gone up too far and were going to come down. But the process by which the house prices had to come down, and even from today will have to come down even more, was exacerbated by the fact that for several years we were building too many houses, as a result of which today we still have on the market approximately a full year's extra supply beyond what the rate of family formation warrants. In other words, we have approximately 1.5 million extra houses hanging over the market. Things that go up too high inevitably come down, and they did. The first step was that house prices came down. House prices peaked in the middle of 2006. Since then, the average house in the United States has had its price fall by approximately 28%. Looking at the futures markets, it's easy to tell that the price of houses is going to come down yet further. From today's level, the futures markets are predicting another 18% decline in house prices. Second, borrowers, especially those who had no prospect of repaying the loans that they took out anyway and were simply counting on house prices rising, but even others besides have started to default on the loans that they took out. As a result, we now see home foreclosures spreading across the country, and for those who are paying attention to the evening news, that is what President Obama's package on mortgage foreclosure relief announced this afternoon is meant to forestall. Next, the oddity in this process, and to be frank, the one step in the entire process that I think is impossible to explain on the basis of what we know today, is that the banks, instead of sticking to the business of making the loans, packaging the loans into securities and selling them to investors, somehow made the decision to invest in the very securities that they were selling to other investors. And here we get back to the credit mechanism. If the losses on these claims to loans that will never be repaid were merely held by pension funds and townships and ordinary individual investors, that would be bad. But the fact that the losses were sustained also by the banks made this whole process turn into a credit crisis. The reason is that the banks, once having taken those losses, now are insolvent. Most of the major banks in the United States now have negative net worth. In other words, they owe you more than they earn. If they had to liquidate their entire supply of assets in order to pay off their depositors and other creditors, they could not do so. And as a result, they are limping along in a situation of being unable to lend, and importantly, for a reason that simply increasing the reserve base of the banking system, even by a factor of 20-fold, is not going to address. So we have a credit crisis in the mechanism that provides lending to the economy. What then has been the effect in the economy? First, with the price of houses going down rapidly, and moreover with an extra 1.5 million units sitting there on the market, it's no surprise that residential construction in the United States has gone down sharply. We were building 2.25 million houses per year just 3 years ago. Today, if the pace of January continues, we will build only 500,000 houses in all of 2009. In other words, the pace of residential construction has fallen by more than a factor of 4. And furthermore, when people do not move into new houses, they do not buy the furniture, the refrigerators, the air conditioners, the carpeting that normally goes into a new house. So the decline in the residential construction industry is automatically multiplied up at least by a factor of 2 in order to account for the decline in the purchases of consumer durables. Next, the even larger problem, as if the problem in the housing industry were not already large enough, the even larger problem is that the lack of availability of credit has already begun to impair the ability of both consumers and businesses to spend. Take consumers, for example. In the United States, more than 1 car out of every 2 that's sold is bought with a car loan. With car loans unavailable, it's no surprise that the car companies are now struggling to sell even 10 million cars per annum, whereas a normal pace for the United States would be more like 16 or even 17 million cars per annum. To be sure, roughly half of those cars come from abroad, but the other half are produced by American companies employing American workers here in the United States. And so when car sales go down from 16 or 17 million units a year to 10 or below, why? Because nobody can get a car loan. This means people out of work, and again, not just at the car companies, at all of the other companies that supply everything from rubber to steel to fabric to the people who make the cars. How about businesses? In the final quarter of 2008, the quarter ended 6 weeks ago, business investment in new factories, new machinery, new equipment fell at the largest rate we've seen in years. Why? Again, because businesses cannot get credit. In the United States, businesses can and do use their internally generated profits in order to pay for new machinery, new factories, and new equipment. But 2/3 of all of the investment spending that American businesses do is normally financed by borrowing. If the credit mechanism is broken, the ability of American businesses to invest is also broken. And then finally, with the economy down in part because of residential construction and the spillover to consumer durables, with consumers not spending on cars and other things that they would buy on credit, with business investment down because firms can't get loans, it's no surprise that the stock market has declined sharply. And as of today, the decline in stock prices has triggered a loss of wealth in the American economy equal approximately to 3 times the quantity of the loss of wealth attributable to declining house prices. With less wealth, less net worth, consumers are going to spend less, and with less worth to their housing stock, to their stock of plant and equipment, firms are also going to invest less. So across the board, whether we're looking at housing, whether we're looking at business investment, whether we're looking at car purchases, other consumer durables, ordinary consumer purchases, the economy has a problem, and the heart of that problem is the credit sector. Now, what are we going to do about this, and what should we do? I think we need to do 3 things, and the scorecard is 1 done, one more or less done, one done but not really, and one yet to be attempted. The one that's already been done is the one Cathy Minehan explained very well, namely expansionary monetary policy. The reserve base of the banking system is enormously increased. The Federal Reserve has implemented new credit facilities, and there have been targeted bailouts by the Federal Reserve of key institutions like Bear Stearns. As a result, monetary policy has done its job, and I don't think it's plausible to look for any serious further contribution from the central bank. Second, we need expansionary fiscal policy. That is what the package proposed by the President and then amended in Congress and enacted last week is all about. One can debate indefinitely whether the mix of tax and spending was correct. One can debate indefinitely whether the nearly $800 billion total amount was enough. None of this really matters. The important point is that we have enacted a very large fiscal stimulus program, and with high predictability, if we get to next September and it looks as if the fiscal program is not adequate, there will be another one. And with equal probability, if we then get to a year from now, and the one that we've just done and the one that's enacted in September still are not sufficient, there will be another one after that. So I would say the scorecard is so far, expansionary monetary policy has been done. Expansionary fiscal policy has been either done, if one is an optimist, or begun, if one is a realist. What remains to be done? The President today announced a small program to forestall on mortgage foreclosures. The President's program is $75 billion, which is not insignificant, but nonetheless is far too small to be significant compared to the problem at hand. Substantially all of the houses bought in 2005, 2006, and 2007 now have prices significantly under what the houses were sold for. If people had put down significant down payments on their loan, then the fall in the house price wouldn't matter. To take what was the median house price a few years ago, if a person bought a house for $300,000 and let's say put up $50,000 so that the loan value was $250,000, then if the house price fell by $30,000, $40,000, $50,000, the person still has a house that's worth what the loan is for. By contrast, the reality was that the lenders throughout our economy had reduced their lending standards to such a degree that most people put up little, if anything, in the way of down payment.